the EPS. In this lesson, we're going to talk about something a little bit different, and it's something that Warren Buffett calls owner's earnings. Okay, so starting from the very beginning, we know that the income statement is where we figure out what the EPS is, or the net income of the business. And so when we turn to that income statement and we look at the very bottom line, that's where the net income is at, and this is the profit of the company. If we want to figure out what that profit is per share, what we do is we just take that net income and we divide it by the number of shares outstanding, and that tells us the EPS, or the earnings per share. You also know from previous lessons that that EPS is then paid to you as a shareholder, as the owner of that business, two different ways. It's paid to you directly through a dividend, which would be the top method. And for this example, we are just going to use an EPS of $2. And we're going to assume that $1 is paid to you directly, straight as the owner, through a dividend. And then the other dollar is reinvested back into the business. Okay, and so what we're going to be talking about whenever we talk about owner's earnings is we're really going to focus on that bottom number where that $1 is being reinvested back into the business. Okay, so I've got a very generic scenario here, and we're just going to use the same $2 of EPS that we were just talking about before. Okay, and let's assume that we're looking at a business that has a book value of $20. So as we start over on the far left of this slide, you can see that the previous book value prior to 2009 was $20. And if we had a business in a very generic scenario here that had a $2 earnings per share, we're going to assume that $1 of that earnings was paid to the owner as a dividend, and that the other dollar was reinvested back into the company. And what it did is it made the book value grow by $1. So we see the book value change from $20 to $21 in 2009. The same exact scenario occurs in 2010, and we see the book value raised to $22, and $1 of a dividend was paid. And then in 2011, the exact same thing, which made the book value raised to $23. So in that scenario, what was the earnings per share? What was the EPS? And then also, I want to know what was the owner's earnings. Okay, so for that scenario, when we look at the accounting, okay, when we're talking about the accounting, we're talking about the earnings per share, that number that's reported at the bottom of the income statement, which is $2. Whenever we talk about owner's earnings, we also, in that scenario, through analysis, we saw that the owner's earnings was also $2. And the reason that the owner's earnings was $2 is because we earned $1 in the dividend, and we actually saw the $1 that was being reinvested into the company actually materialize in the book value. Okay, so in that scenario, we had the actual accounting earnings that were being reported be exactly the same as the owner's earnings. So what we're going to do next is we're going to make the scenario more realistic. So that last scenario isn't very realistic, but the next one is going to be more realistic in that the money that's being reinvested back into the company might not actually turn into owner's earnings. And so let me demonstrate that for you. Okay, so we have the exact same company. The book value prior to 2009, we're going to say, is $20, and that the earnings, the EPS for 2009, according to the accounting, that number that was reported at the bottom of the income statement is $2. Okay. We're going to assume that still $1 is being paid into the being paid to you as an owner through the dividend. Okay, but this time you only saw 50 cents of book value growth, and the book value increased up to $20.50. Okay, in 2010 we saw the exact same thing. Not the whole dollar was materializing into our book value, and same thing in 2011. So instead of seeing the book value at the end of 2011 up at $23, the book value this time is only $21.50. So this disparity that we're talking about is the difference between reported earnings, which is coming from accounting, and owner's earnings, which is slightly different. So let me show you what this looks like. So in that scenario, we had the accounting earnings was $2, and the owner's earnings, which is how Buffett would describe it, was only $1.50 per year. Okay? So where did that 50 cents of earnings per share go? Because that's your money. As the owner of the business, that 50 cents, which never materialized, that's your money, but where did it go? Why didn't you see all that materialize? So whenever we look at the two directions that EPS can go, that accounting EPS that's at the bottom of the income statement, we know that it can be paid two different directions. We know that it can go to the owner. And when that happens, when that's paid as a dividend, that materializes as owner's earnings immediately. Okay, we know that that's part of the owner's earnings. Now, whenever we look at the dollar that was invested down in the business, this may or may not turn into owner's earnings. Okay, and that's what we're going to discuss here on this next slide. Is we're going to focus in there on that dollar that's going towards the business. So when we look at this, you can see the EPS of $2. We invest $1 back into the business. Okay. And we're going to look at just two paths that dollar could be invested. It's obviously a whole lot more than this, but in order to make this kind of make sense, we're just going to do two paths. So on one path, over on the left, you can see that 50 cents was used to invest in another stock. Okay? So just imagine a company, okay, has the ability to take their earnings and actually invest that money into yet another company. Okay? And when they do that, that company is going to continue to pay them earnings. When a business would do something like this, that 50 cents, we'll just say that they use 50 cents to invest in another stock pick, that's going to show up on their balance sheet as another asset, and so that would materialize into extra book value during the next accounting period. Now, the other 50 cents, as we look to the right there, at the bottom right, that 50 cents was used to invest back into the company, but it was invested in a manner that replaced the computer, we'll say, it replaced the computer that they already possessed. Okay, so that computer, imagine the old computer being on the balance sheet listed as an asset. That computer was then replaced with a new computer that they bought with this 50 cents of this share. And so the new computer replaces the old computer on the balance sheet, and that didn't add any money onto the balance sheet. It didn't add any more money onto that book value. Okay. So as far as we're concerned, that it's almost like that money disappeared as we look at the earnings per share and how it didn't materialize into more book value growth. So same concept, but I have it color coded here. You can see how the dollar that was paid to the owner as a dividend is green, so that's our owner's earnings. When we go down to the dollar that was invested into the business, only half of it turned into owner's earnings. That money that was invested in the stock pick, that was additionally added onto our balance sheet, okay, where the 50 cents that was invested in the new computer, the old computer was taken off the balance sheet and discarded, and the new one was purchased and put in its place, and we didn't see any book value growth based off of that. So this is our difference. When you see those two green, that's the owner's earnings. That's what Warren Buffett's that's what he's referring to whenever he says owner's earnings. The 50 cents that comes off, you could maybe call that the company's earnings because that's not something that you actually saw materialize. So now that you understand the basic concept of what owner's earnings actually represents and what that terminology means, let's go ahead and try to do this for a real business, and we're going to use Walmart in order to exemplify this. Okay, so here's Warren Buffett's quote on owner's earnings. And this quote was pulled from his shareholder letters from 1986, and I'm going to read this for you. So Warren Buffett says, owner's earnings are reported earnings plus the depreciation, depletion, amortization, and the certain other non-cash charges to include or exclude deferred taxes, and less the average annual amount of capitalized expenditures for plant and equipment, and etc., whatever else might fall into that category, that the business requires to fully maintain its long-term competitive position in its unit volume. So I'm sure for a lot of people that just sounded like Charlie Brown's teacher. So what I'm going to try to do is really break that down and make sense of that quote for you. Okay, so don't get intimidated with this slide. All this is the cash flow statement for Walmart. So I'm sure if you've looked at the videos prior to this one, you've seen me pull up a cash flow statement before. If you're using MSN Money, you're just going to go down to the bottom left-hand side and you'll see a tab that says cash flow, and you're going to click on that for Walmart. And what will come up is what you see here on the slide. Okay. Now, that quote that you saw on the previous slide from Warren Buffett, he described what owner's earnings was. And so what I've done is I've broken it down into kind of an equation there for you on the right-hand side. So as we focus in there on the right-hand side, you can see it says owner's earnings equal net income plus depreciation plus amortization and all those different categories minus the capital expenditures. Okay. And the deferred taxes can kind of go either way depending on how it's listed. So as we look at all those items right there, one of the advantages that we have today that Buffett didn't have back in 1986 is the cash flow statement. Back whenever he wrote that piece that we pulled the quote from, there was only an income statement and a balance sheet. So he didn't have the luxury of kind of viewing a cash flow statement. But for us, it's a whole lot easier because all these numbers are listed right on the cash flow statement. So as we look over there to the cash flow statement, what I'm going to do is I'm going to highlight where each one of those terms are at from the left-hand side on the cash flow statement to the right-hand side where I've kind of laid out the basic equation. So the first thing I'm going to highlight is the net income. You can see where it's at on the cash flow statement because it's highlighted in green. Okay, now when you look at the depreciation, you can see it's on the next line down, and it's also highlighted in green now. Then the amortization, that's highlighted in green, and for Walmart, they don't have anything listed on their cash flow statement, so it's going to be 0. Okay, our deferred taxes. Now this one's a little bit trickier, and you can see I highlighted this one in yellow, and the reason I highlighted it in yellow is because sometimes it's positive, like in 2012 and 2011, and then when you look in 2010, it's actually a negative number. And then you have the non-cash items, and you also have changes in working and capital. And so I'm going to highlight both of those in green, and you can see that the changes in working and capital can also be a plus and a minus, just kind of like our deferred taxes. But all of those items are listed right there, and they're all summed up, which is great. We don't even have to do the math for that. All those are summed up right there under the cash from operating activities, which I now have highlighted in green. Okay. So that's really the overall, all those things that are listed there all turn into that one line at the bottom there where it says cash from operating activities. That's the thing we want to focus on, okay? Now, the thing we have to subtract out is the capital expenditures, okay? Now, capital expenditures are those things that we're spending money on as a business in order to sustain our operations. So if we were going to go purchase stock and it's a new asset that's going to create a new stream of income, that's not going to be listed under capital expenditures. Only things that we're currently using in order to produce current income streams is what's listed under capital expenditures. So that's why we're going to be subtracting all of that out from that operating activity cash that we have right above it. Okay, so to simplify that equation, we can see that I have everything kind of fogged out there, and you can see that the two numbers that really mean a lot is that cash from operating activities and then the capital expenditures. And what we're going to do is we're just going to take the difference of those to come up with the real owner's earnings opposed to the EPS that's being reported on all those top level pages and things like that. So let's compare Walmart's accounting earnings that's being reported at the bottom of the income statement versus that owner's earnings that we just showed you the little formula for. Okay, so I've kind of fogged out all the numbers here, and I'm just showing the numbers that you need in order to account for these things. So the first thing that we're going to do is we're just going to calculate the number at the bottom of the income statement from the cash flow statement. Okay, and in order to do that, we're just going to look at the very top number, which is our net income, and that comes straight off our income statement. Okay. That's that bottom line number at the bottom of the income statement. So that number you can see is listed, and then I have the number of shares diluted, which I pulled off of the income statement, listed underneath of that. And in order to find our EPS diluted, all we're going to do is we're going to take the net income and divide it by the number of shares outstanding, which is we're going to use the diluted number because that's going to give us a more accurate number. When we divide those two, that gives us our EPS diluted. And this is the number that's the accounting number. This isn't the owner's earnings. We're going to do that next. Okay, so as we go through this for Walmart, you can see 2012, we had 4.71, all the way through 2008 where it was down at 3.23. Okay, so all of that you should have already known from all the previous lessons. Now what you haven't done yet is the owner's earnings. So in order to do this, we go to the cash flow statement, and you can see I have the top number there is the cash from operating activities, and I highlighted that in yellow right there for you to see. And then right underneath, you can see we have the capital expenditures, which is now highlighted in yellow. And what we're going to do is we're just going to take those two numbers and we're going to find the difference between them. Okay. Now you can see that the capital expenditures are already listed as a negative number, so I guess you could technically say we're going to add them together, but all you're doing is you're finding the difference between those two numbers if they weren't listed as negatives on this particular sheet. So when we do that, we come up with 10,745 for year 2012, all the way through 2008, where it's 5,705. Now, those numbers are obviously billions because we've dropped all the zeros off of them, but that's going to give you that difference right there is your owner's earnings, okay? And in order to figure it out per share, we're just going to divide that difference by the number of shares diluted, and then at the bottom you can see we have the owner's earnings diluted, which for 2012 it was $3.09, and down to 2008 where it was $1.40. Okay, so let's put these two numbers right next to each other. Let's look at the EPS that was the accounting number, and then let's look at the owner's earnings EPS and see what we came up with. Okay, so here's that right now. At the top we have the accounting earnings, and underneath of that we have the owner's earnings that we just calculated. Okay, now instead of looking at the number, the difference in the number there, I made a little chart so it's more visual for you to see the difference between the two. So when you look at the chart and you see the blue in the chart, that's the owner's earnings. When you see the red, that's the accounting earnings that you see. So when you look at that comparison, you can see how much higher the accounting earnings are saying that the numbers are versus what's actually being materialized for the owner. If you were the shareholder of this, you would see the number in the blue. That's what you would actually be seeing come into your pocket, opposed to what's being reported on the accounting income statement, which is the red. So that's a pretty significant difference when you look at that. And this is why Buffett places so much value in this calculation and understanding what owner's earnings is, because he knows as a shareholder that's what he's actually going to see opposed to what's being reported. So let's make this really fun. Okay, on the top we have the accounting earnings, and then we have the owner's earnings underneath of that. Now what I'm going to do is I'm going to show you what actually materialized during that period from 2008 to 2012. And in order to do that, I listed the dividend, which you can see right there. I have an arrow next to it. You can see the dividend during that time period, and then you can see the change in the book value during that period. And all I did is I added up those two numbers, okay? And then you can see I totaled them for each year. So for like 2012, the total for the shareholder was $2.83 because they had $1.37 in the book, and they had $1.46 paid to them in a dividend. And so what I did is I added up all of those dollars that you would have received as a shareholder if you owned Walmart from 2008 to 2012. You would have received $11.54, either indirectly paid into the book or paid directly to you for owning those shares, and that money was paid to you as a dividend. So what I find really interesting here is look at the very top number where we had the accounting earnings. If we were going straight off that EPS, we would assume that we'd be paid $19.93 if we would have owned if we would have owned one share of Walmart throughout that time frame. Then, as we take a step down and we look at the owner's earnings, which we calculated off of the cash flow statement, we'd have a much lower number in that we would have only received $14.05, because a lot of that money would have been paid to sustain operations. Because when you think about Walmart, they've got an enormous inventory, they've got enormous number of buildings. All those things require a lot of capital, and it's a lot of capital that's going to be reinvested back into the business just to sustain operations, not to grow. Okay, so that's why you're seeing that decrease. But what you actually saw materialize as the shareholder is what's down at the bottom, and that's the dividend and the growth in the book. And that was only $11.54. Okay, so this is pretty interesting to look at these three different lines here and see what the owner actually received versus what you would have calculated versus what was being reported. So as we look at this and we understand Buffett's opinion on goodwill and a couple other things, we can see why Buffett likes to minimize his net tangible assets. And this is the reason why. Tangible assets will most likely need replaced or maintained. It's like that computer. It's like all the inventory. It's like the buildings for Walmart. All those things need maintained. All those things need to be replaced. And what this means is a decreased amount of owner's earnings. So what's the point of all this is what you're probably asking. Okay, why are you telling me this now, and what should I take away from this? How can I use this to my advantage? So I have a lot of points here, and I'm going to try to go through these as quickly as possible. There's a lot of people on the internet that treat Buffett's description of owner's earnings like it's the holy grail of value investing. And to a certain extent, it kind of is, because you're actually calculating what you're going to receive opposed to what's being reported. I think that owner's earnings is very important to understand, but as far as understanding his calculation and getting into the intricacies of that short-term look, I'm not convinced of that. I believe that understanding the concept of owner's earning is more important. So if you understand what owner's earning is about, that's what's important. Not necessarily maybe doing that particular calculation. Because as you saw on the last slide, or the last two slides, what we calculated was actually a little bit different than what we actually saw materialize from the dividends and the book value growth. I think the bottom one's more important. Okay? Remember, the actual owner's earnings is two things. It's that book value growth and it's the dividends. That's what owner's earnings really is. Okay, so in order to understand why maybe a lot of people on the internet are placing so much value in his calculation is because they're kind of ignoring the context of what his shareholder letter was written. Back in 1986, whenever Buffett wrote this, the reason he was explaining his opinion on how to calculate owner's earnings was because he was conducting a 100% buyout of a company called Scott Fetzer's. And when he was doing that, he was paying almost 100% premium over those net tangible assets that the company was listed for on their accounting, for their income statement and for their balance sheet. So in order to buy this company, he had to prove his valuation with accounting terms and cap rates whenever he came up with what he thought that the book value on the company was and how much their earnings were. Then he had to take a capitalization rate on top of that. And when he's doing this, he had to explain to his shareholders in 1986 why he was paying such an enormous premium for this company. And so this was really the reason for his detailed explanation. He had to explain the accounting gymnastics that took place as he conducted that acquisition of that business. So I think that whenever people take a step back and they look at the context of why Buffett was explaining that really in-depth owner's earnings calculation, it was more in an effort to show his shareholders why he had bought that company, and this was during an entire 100% acquisition of another business. So here's my recommendation, okay? Understanding that calculation is great. You have to fully understand the difference, though, between owner's earnings and accounting's earnings from a general standpoint. What I was talking about at the very beginning of this briefing is what you have to understand. You have to understand that all that EPS isn't going to necessarily materialize into actual earnings into your pocket. So that's my first recommendation, is that you truly understand the difference between accounting earnings and owner's earnings. That's what I think is important, just understanding that difference. The second thing that I'll tell you is to continue valuing your companies based off of the book value growth and the dividends, because ultimately, at the end of the day, if that company invests all the money that's being put back into the company, well, you're not going to see the book value grow. So you're going to immediately see that trend, especially if you're buying a stable company, which is mandatory for all of this. If you're buying a nice stable company and you're not seeing their book value grow, well, that tells you immediately that the only money that's actually going to turn into owner's earnings is your dividend. So I think that you're going to be well off by just sticking to your estimates of how much is the book value growing, how much are they paying a dividend, how much is reasonable into the future. Okay, the third thing, when you're assessing the future earnings of a business, ensure that your estimate is going to remain stable or increasing from what has happened in the past. So after we're done with the fourth point, I'm going to show you exactly what I mean by going to MSN Money and pulling up Walmart, and I'm going to show you what that third recommendation is talking about. And then the fourth recommendation, I think that if you're buying a company, you need to check that cash flow statement quarterly when those earnings are reported, to ensure that the ratio between that operating activities and your capital expenditures remains intact. So for Walmart, we have a real good idea. If you remember that graph that I showed you, when we looked at that ratio between what was being reported and what was actually occurring, we have a pretty good idea of how Walmart operates and how much capital expenditures they need to use in order to maintain their business and also grow. So when you look at that, you need to make sure that that ratio between those two numbers is remaining intact. And I'm also going to show you that right now. So let's go ahead and do the third recommendation, and then I'll show you the fourth recommendation. So here I am at MSN Money, and in order to pull up Walmart, we're just going to type WMT and hit enter. Okay, and you can see here's Walmart. And the first thing that I said in the third recommendation was that you have to look at the company's future earnings, okay? So in order to get a brief idea of what their past earnings are, let's go ahead and pull up their earnings over the last 10 years. So in order to do that, I clicked here on the 10-year summary, and you can see this is Walmart's earnings per share over the last 10 years. So it went from 176 to 246, clear up to an EPS of $4.54 here in 2012. Okay, so we can see that growth, that trend in that earnings per share over the last 10 years. So let's look at what the earnings are going to be in the future. So in order to do that, we come over to the left-hand side here, right where my mouse is at, and we're going to go ahead and click on the tab titled Earnings. Okay, so when we look at the estimates for fiscal year 2013, we can see that the earnings are $4.90. Okay, that's higher than what they are in 2012. Then when we look at the earnings, the projections for 2014, the projections are $5.36. Now, that's among the number of analysts that are predicting this are 22 for 2013 and 20 for 2014. Now, what are the chances of those earnings actually coming into fruition? Probably slim to none that those numbers are actually going to turn out like that. But I would much rather see a forecast that's projecting positive earnings than something that's negative. So this is a great sign, and this is exactly what we're looking for as we look to the future and what the earnings might look like. So the next, the last recommendation, that fourth recommendation, was that now that you see that the earnings are projected to continue to increase into the future, now I think what you need to do is you need to go down and look at the cash flow statement. Okay, so let's click on the cash flow statement right here. Okay, and we're going to pull up, we look at right here from the annual. And what you're going to continue to do into the future is these cash flows continue to develop, and you're probably going to want to pull up the interim for each quarter. Okay, so you'd click right here on your interim. And you would continue to assess this line right here, the cash from operating activities, and you would compare that to the capital expenditures. You're going to constantly be comparing that ratio between those two to make sure that it stays in check. Now I'm going to caveat this. That ratio between those two is, for when you get into a more volatile company, Walmart's pretty stable. When you get into a little bit of a more volatile company, that ratio is going to constantly be changing up and down and kind of all over the place. But the long-term trend is what you're really looking for. You want to make sure that it's not continuing to decrease. You want to make sure that it's staying level or maybe even becoming more favorable. So there's a little bit of a demonstration on how you can implement the two recommendations that I had for you, recommendation 3 and 4, off of the final notes that I had for this lesson. So this concludes Course 3, Unit 7, Lesson 7, What is Owner's Earnings?